All right, let's kick off today's deep dive by imagining a corporate dilemma. You're a CEO, right? You're grappling with, well, everything from securing your company against the next big cyber threat to ensuring your best talent doesn't walk out the door, all while trying to navigate a pretty volatile global market.
It's a lot.
It is a lot.
Yeah.
So who's the quiet giant you turn to? The invisible architect shaping these crucial decisions across industries.
That would be Marsh McLennan Companies, Inc., MMC.
Exactly, MMC. And our mission today is to go beyond the headlines, beyond just the balance sheets, and really understand what makes MMC tick. Not just a player, but a true powerhouse at that intersection of risk, strategy, and people.
Right.
We're peeling back the layers, the business model, financial engine, its competitive arena, to basically uncover the insights that genuinely matter for you, whether you're maybe a seasoned investor, a strategy enthusiast, or honestly just someone who loves understanding how these global titans operate.
And that powerhouse description, it really isn't hyperbole. What genuinely differentiates MMC, I think, is that it's not just a collection of, market-leading businesses bundled together.
Okay.
It's a meticulously engineered platform. Marsh, Guy Carpenter, Mercer, Oliver Wyman, they don't just coexist, they actively amplify each other. We hear synergy thrown around a lot, but here, it's really the operational bedrock. It creates truly durable advantages.
How so? Give me an example.
Well, imagine a situation where maybe a major competitor could chip away at one part of their business, say, like a specific insurance policy placement.
Okay.
But because MMC has its insights, its data, its relationships woven through so many critical aspects of that client's entire enterprise, well, their switching costs become incredibly high.
Right. Makes them sticky.
Very sticky. This integrated approach, that's what makes such a compelling case for MMC as, potentially a superior long-term investment. One characterized not just by growth, but really remarkable resilience and consistent shareholder value. It's about more than just selling services. It's about becoming, truly indispensable.
Indispensable. That is a strong word, and you've really highlighted the integrated aspect. But
Yeah.
before we get maybe too lost in the financial models, let's just ground ourselves. What is Marsh McLennan at its absolute core?
Sure. Well, fundamentally, this is a firm with a lineage stretching way back to 1871.
Wow, okay.
Yeah, born from the very origins of risk management itself. Yet it's far from a relic. It's dynamic, constantly evolving, dedicated to providing advice in those three critical interconnected spheres we mentioned: risk, strategy, and people.
And their stated purpose, I think I saw this in the source material, it's something like to build the confidence to thrive through the power of perspective.
That's the one. It's about bringing together all this diverse expertise to not just, mitigate problems after they happen, but to proactively empower organizations and even societies to move forward confidently.
Okay, so can you give us maybe a more vivid sense of how that purpose translates into tangible client value, especially today with things being so complex?
Certainly. To really grasp the power of MMC's integrated structure, maybe think of it as like a master orchestra conductor for a global enterprise.
Okay, I like that analogy.
A client isn't just buying a single instrument service, right? They're getting the entire symphony. So consider a major multinational client today, maybe a big global manufacturing giant. They're facing the daunting task of transitioning to a low-carbon economy.
Huge undertaking.
Huge. And it's not just an environmental initiative, it's a colossal business transformation. So for Oliver Wyman, this means a deep strategic consulting dive. What new business models are needed? How do we re-engineer supply chains? What are the competitive implications?
Like the big picture strategy stuff.
Exactly. But immediately, this strategic pivot creates a whole new universe of risks. So Marsh, their leading insurance broker, steps in. They identify and mitigate new physical risks like, say, extreme weather events impacting facilities and new liability risks that come with green technologies or maybe carbon capture initiative.
Okay, so strategy creates risk, Marsh handles the risk.
Precisely. And then those new risks for the manufacturing giant become new risks for their insurers, which is where Guy Carpenter, the reinsurance specialist, becomes vital. They structure sophisticated reinsurance solutions to protect those primary insurers.
The insurer's insurer.
Kinda, yeah. And finally, none of this actually happens without the right workforce, right? So Mercer is crucial here, advising on reskilling, talent development, ensuring the health and well-being of employees through what is a massive organizational change.
Okay, so MMC covers strategy, risk, reinsurance, and the people side, all interconnected.
All holistically. And this isn't just convenient for the client, it's a strategic competitive advantage for MMC. It means, like we said, higher switching costs. Disentangling from MMC would mean trying to piece together maybe a dozen different specialized firms, and you'd lose that integrated perspective.
Yeah, you lose the conductor.
Yeah. You lose the conductor. It fosters far stickier relationships, and it creates immense cross-selling opportunities between all four businesses. No single specialized competitor can really offer this breadth and depth of interconnected solutions.
That's a brilliant analogy, the master orchestra conductor. It makes perfect sense why this integrated approach creates such, well, durable advantages. So we've touched on the four brands. Let's really pull back the curtain on this formidable team. You mentioned Marsh and Guy Carpenter. Can you walk us through each of these four market-leading businesses in a bit more detail? What they do and, crucially, why their specific role within MMC matters so much?
Absolutely. Let's start with Marsh. Marsh is truly a titan in its field. This is the world's leading insurance broker and risk advisor. When we say they pioneered risk management, we mean they fundamentally shaped how businesses think about, identify, and quantify risk, moving way beyond just, buying an insurance policy.
So it's more advisory now.
It's deeply advisory. Marsh doesn't just sell policies. They act as strategic partners. They offer data-driven risk advisory services, and then, armed with that insight, they design and place insurance solutions across pretty much every conceivable specialty. Think cyber risk, political instability risk, the unique challenges of aviation, complex construction projects, you name it.
Okay.
Their global scale and deep expertise allow them to secure the best terms and pricing for clients. Ultimately, it helps organizations significantly reduce their total cost of risk. For you, the listener, understanding Marsh means understanding they're the frontline shield for countless businesses against an increasingly volatile world.
And working hand in glove with Marsh, particularly for the insurance sector itself, is Guy Carpenter. Now, reinsurance. That's a concept that might sound a bit abstract to some, but it's fundamentally critical, right?
It is absolutely critical. And Guy Carpenter is the global leader here. While Marsh works mainly with corporations buying insurance, Guy Carpenter primarily helps insurance companies manage their own risk portfolios.
Okay, so they're helping the insurers themselves.
Exactly. Imagine an insurer that covers thousands of homes in, say, a hurricane-prone region. If a major storm hits, the payouts could be catastrophic for that insurer. Guy Carpenter steps in to help that insurer offload some of that concentrated risk to other insurers or reinsurers. That process is called placing reinsurance coverage.
Spreading the risk around.
Spreading the risk. They use incredibly sophisticated analytics, advanced catastrophe modeling, capital advisory services, all to ensure that insurance companies remain stable and solvent, even after massive industry-shaking events. Without Guy Carpenter's expertise, honestly, the entire insurance industry would be far more fragile, less capable of absorbing the shocks that keep our economies functioning.
They're like the shock absorbers for the shock absorbers.
That's a perfect way to put it, yes.
Okay. Now, shifting gears to the human capital side, we encounter Mercer. In today's competitive landscape, you always hear that human capital is the company's most valuable asset. What exactly does Mercer do to optimize that, and why does their leadership position matter so much?
Mercer is a global leader focused on the entire spectrum of health, wealth, and career-related matters for organizations. They're helping clients navigate the complex, often, emotionally charged landscape of employee benefits, retirement planning, talent strategy.
All the people stuff.
All the critical people stuff. Think about the soaring costs of healthcare globally. The intricacies of pension plans or defined contribution plans, the constant battle to attract and retain top talent, especially in this sort of gig economy environment. Mercer steps in. They design innovative health and benefits programs that are both cost-effective for the company and attractive to employees.
Finding that balance.
They also provide investment management and consulting, often acting as an outsourced chief investment officer, or OCIO, for many organizations' retirement funds, ensuring their long-term financial health. Their #1 market position globally in both health and benefits brokerage and as an OCIO, well, that means they have unparalleled data, access to best practices, and significant negotiating power, which directly translates into better outcomes and often significant cost savings for their clients. In essence, they empower companies to unlock the full potential of their people, which is more crucial now than ever, arguably.
Absolutely. And finally, rounding out this truly impressive quartet, we have Oliver Wyman. These are the strategists, the advisors to the C-suite, on the biggest, most complex issues. How does Oliver Wyman differentiate itself in the highly competitive world of top-tier management consulting? What kind of problems are they tackling?
Right. Oliver Wyman operates at the very apex of global management consulting. They're a top-tier firm competing head-to-head with the names everyone knows: McKinsey, Boston Consulting Group, Bain and Company.
The big leagues.
The big leagues. What often sets them apart is their combination of deep industry expertise. They often specialize very deeply in sectors like financial services, aviation, energy, combined with specialized functional expertise in areas like strategy, operations, risk management, organizational transformation. They provide high-impact, project-based advisory.
So specific high-stakes projects.
Exactly. A client might engage Oliver Wyman to navigate a massive merger and acquisition, or maybe completely overhaul their operational efficiency, perhaps develop a strategy for entering a new global market, or even build a robust risk framework in a rapidly evolving regulatory environment like AI ethics or something. They are essentially the intellectual horsepower for C-suite executives, helping them solve their most pressing, sometimes existential, strategic challenges with rigorous analysis and, crucially, actionable insights.
That's a truly powerful lineup, from safeguarding against risk with Marsh and Guy Carpenter to shaping future strategy with Oliver Wyman and nurturing human capital with Mercer. But it does beg a larger question. With such a diverse set of businesses, how does MMC not just maintain this leadership across all these different segments, but consistently expand it, especially given their immense global footprint?
Yeah, you've hit on a really crucial point there. A cornerstone of MMC's sustained leadership is its truly immense global scale and its incredibly diversified client base. You mentioned the footprint: over 90,000 colleagues spread across more than 130 countries, generating over $24 billion in annual revenue.
Wow.
This isn't just a big number, it's a strategic necessity. Imagine a multinational corporation that needs consistent risk management advice or talent strategy across dozens of different jurisdictions, right? Each with its own regulations, its own cultural nuances. MMC's footprint means they can provide seamless, localized expertise pretty much anywhere in the world. Smaller, regional players simply cannot replicate that. It's a massive competitive moat.
Yeah, that global reach is hard to overstate.
And beyond that geographic reach, their client base is incredibly diversified. They serve the largest corporations across virtually every industry you can imagine, but also small and mid-sized businesses, governments, nonprofit organizations, even high-net-worth individuals through certain channels. Geographically, their revenue is a model of balance, too. Roughly 49% from the U.S., 32% from Europe, the Middle East, and Africa, EMEA, 11% from Asia-Pacific, and about 4% each from Canada and Latin America.
So spread out pretty well.
Very spread out. This granular diversification, both by client type and geography, acts as a powerful shock absorber. It provides significant stability and resilience. A downturn in one specific sector or one particular region might be offset by strength in another. It makes their overall earnings stream remarkably robust against economic fluctuations. It's a strategic design that minimizes single points of failure.
It really sounds like they've thought carefully about building a resilient structure from the ground up. Okay, let's unpack this structure further. Marsh McLennan isn't just one big amorphous entity. It's essentially built on two massive reporting pillars: risk and insurance services, or RIS, and consulting. And what sounds really clever is how these two pillars, while distinct, work together in what the source material describes as a symbiotic and counter-cyclical relationship. Can you elaborate on what that actually means for the company's overall resilience? Yeah. The interplay between these two segments is, frankly, brilliant. It's a key reason for MMC's enduring stability. So imagine the economy experiences a significant downturn. Okay. In times like those, companies often pull back on discretionary spending, right? This would typically hit management consulting firms quite hard, as big strategic projects can often be deferred or scaled back. Makes sense. Consulting feels more optional sometimes.
It can be perceived that way. However, here's where the counter-cyclical nature kicks in. The demand for risk management and insurance. Well, it doesn't just hold steady in a downturn, it often increases. Businesses still absolutely have to protect their assets, manage their liabilities, and navigate new emerging risks that often surface during periods of economic stress.
Right. Risk doesn't go away in a recession. It might even get worse.
Exactly. So the revenue generated by the risk and insurance services segment, that's Marsh and Guy Carpenter, is highly recurring and largely non-discretionary. This steady, essential cash flow provides a really robust financial foundation that significantly offsets any potential slowdown in the more project-based, perhaps more discretionary consulting segment. So, while a pure-play consulting firm or a pure-play insurance broker might experience more volatile earnings swings,
Hmm.
MMC's integrated structure smooths out its consolidated financial performance. It makes its overall earnings much less susceptible to the swings of the economic cycle. It's a fundamental structural advantage built into the model.
That structural balance is incredibly compelling. Let's zoom in on the Risk and Insurance Services RIS segment first, as it's the larger of the two, typically accounting for, around 64% of total revenue? This is where Marsh & Guy Carpenter really operate. How does this segment generate its revenue, and what makes that revenue stream so incredibly sticky and reliable?
Sure. In RIS, the business model is largely driven by two primary sources, commissions and fees. Commissions are typically a percentage of the insurance premiums that Marsh places for its clients. So, as the value of assets being insured grows, or perhaps as insurance premiums themselves rise, which happens in what we call a hard market, then Marsh's commission revenue also tends to rise.
Okay, tied to premiums.
Right. Then there are fees. Fees are generated from the extensive advisory and consulting services that Marsh and Guy Carpenter provide. This could range from detailed risk assessments to complex catastrophe modeling for insurers. There's also a smaller but still meaningful revenue stream that comes from fiduciary interest income. This is basically interest earned on client funds that MMC temporarily holds before remitting them to the insurance carriers.
Right, float income.
Exactly. But what truly defines this revenue overall is its highly recurring nature. Client retention rates in this segment are exceptionally strong, often exceeding 90%. Businesses simply cannot afford to operate without proper insurance and risk management. It's not really a discretionary expense, it's a fundamental cost of doing business. And that makes this revenue stream remarkably resilient and predictable, often regardless of broader economic headwinds.
And within that RIS segment, the market leadership and sheer scale are just staggering. Can you elaborate a bit more on Marsh's position as the #1 insurance broker globally? How does that translate into a tangible advantage for their clients?
Marsh's market leadership is truly formidable. As the world's #1 ranked insurance broker, they place over $160 billion in global premiums annually. Just think about that immense volume.
Yeah, as a huge number.
It gives Marsh unparalleled negotiating leverage with insurance carriers worldwide. They can often secure more favorable terms, maybe broader coverage, and better pricing for their clients than smaller brokers simply cannot achieve. This isn't just about price either. It's often about access to capacity, especially for complex or emerging risks where insurance coverage can be scarce.
Okay, so scale equals leverage.
Scale equals leverage, and scale also enables investment. This scale allows Marsh to invest heavily in proprietary data and analytics platforms. They mentioned the Global Risk Insight Platform, or GRIP. GRIP aggregates anonymized data from literally millions of policies and claims globally. This provides clients with unique, data-driven insights into their own risk profiles relative to their industry peers, helping them make smarter risk management decisions. That level of insight is a significant competitive differentiator.
Data is king there.
Absolutely. And Guy Carpenter, operating within the same RIS segment, also holds a top-tier position in the critical reinsurance brokerage market, further solidifying MMC's overall dominance in the broader risk transfer ecosystem. Their recent performance, as noted in the 2022 annual report, was exceptional. They called it the strongest period of growth in nearly 2 decades, fueled by strong client retention, robust new business wins, and a favorable insurance pricing environment, that hard market we mentioned, which contributed to both strong revenue growth and impressive operating leverage.
That's a really powerful picture of the RIS segment. Now let's shift to the consulting pillar. This includes Mercer and Oliver Wyman, making up roughly the other 36% of total revenue. This segment, as you mentioned earlier, is all about intellectual capital, deep client relationships. What kind of services do they offer here, and how do they create value for their clients?
Right. The consulting segment, with Mercer and Oliver Wyman, it thrives on specialized expertise and data-driven insights. Mercer's work often involves long-term, frequently recurring client needs. Things like designing, implementing, and managing comprehensive employee health and benefits programs. Think about the complexities of healthcare regulations globally, rising costs, the demand for diverse benefits that appeal to a multi-generational workforce. Mercer helps clients navigate all of that.
It's a minefield for companies.
It really is. They also provide critical advice on retirement plans and investment management, often acting as fiduciaries, like we discussed with the OCIO role, and of course, talent strategy, everything from workforce planning to executive compensation design. Oliver Wyman, on the other hand, specializes more in that high-value, project-based management and economic consulting, tackling those critical C-suite issues: M&A strategy, optimizing global operations, developing new market entry strategies, building sophisticated risk frameworks. Both firms provide deeply customized solutions that help clients solve complex problems, enhance efficiency, and ultimately drive strategic growth. It's truly about selling expertise and insights that are often simply unavailable elsewhere.
So if RIS is often driven by non-discretionary needs, what are the primary growth drivers for this consulting segment? Are there powerful secular trends that Mercer and Oliver Wyman are uniquely positioned to capitalize on?
Oh, absolutely. This segment is propelled by several undeniable, powerful, secular trends that create sustained, fundamental demand for their services. First, you have rising healthcare costs and the increasing complexity of employee benefits across global operations. This means companies constantly need Mercer's expertise to design effective, compliant, and cost-efficient health and wealth solutions. It's a constant battle.
Never ending, it seems.
Pretty much. Second, the growing complexity of global investment and retirement systems drives demand for Mercer's investment management and OCIO services. Managing pension assets or 401k plans is incredibly complex now. Third, the relentless war for talent, that intense competition for skilled labor, particularly in high-demand tech and specialized fields, necessitates sophisticated talent strategy, compensation design, workforce planning, all areas where Mercer excels.
Right, getting and keeping the best people.
Critical. And finally, the constant need for businesses to adapt to technological and competitive disruption, think AI, digitalization, new market entrants, fuels the demand for Oliver Wyman's strategic guidance on transformation, innovation, and risk management. Mercer, remember, holds the #1 ranking in health and benefits brokerage globally and is the top outsourced CIO. Oliver Wyman consistently ranks among the world's elite strategy consulting firms, and their performance reflects this market positioning. Mercer's recent growth was its strongest since 2008, and Oliver Wyman delivered double-digit growth in 2022. This demonstrates their incredible ability to translate these big macro trends into sustained business success.
That provides a really clear picture of how those two pillars operate and thrive. So bringing it all together, what does this mean for the future? MMC isn't just sitting still. It seems incredibly well positioned to capitalize on these major trends shaping both insurance brokerage and management consulting. You keep coming back to this idea that the most complex global challenges today aren't isolated. They're interconnected issues of risk and strategy. And this, I imagine, is where their integrated structure truly shines, allowing them to capture a larger share of a client's total advisory and risk budget than maybe a standalone firm could.
Precisely. That integrated structure isn't just a convenience anymore. It's arguably becoming an existential necessity for clients dealing with these multifaceted issues. If we connect this to the bigger picture again, think about the rapid adoption of artificial intelligence across industries.
Huge topic right now.
Huge. For a client, implementing AI is a massive strategic decision, right? That's potentially an Oliver Wyman engagement to develop the AI strategy, identify use cases, manage the organizational change. But immediately, AI creates entirely new liabilities. Who is responsible if an AI makes a critical error? What are the data privacy implications? How do you ensure against sophisticated AI-driven cyber attacks?
Right, the risk dimension pops up instantly.
Instantly. And that's where Marsh steps in with new specialized insurance solutions and risk advisory, or consider the global imperative to build more resilient supply chains, especially after all the recent disruptions.
Still a major focus.
Absolutely. That's a significant Oliver Wyman project, remapping logistics and operations. But it's inseparable from modeling and insuring against new disruption, risks, geopolitical, climate-related cyber threats, which brings in Marsh and potentially Guy Carpenter for the insurers. MMC's synergistic capability, that ability to address these multifaceted problems holistically, is a truly durable competitive advantage. They're not just selling individual services, they're solving complex, interconnected problems that, frankly, no single specialized firm can handle alone. And this allows them to effectively capture a significantly larger share of a client's total advisory and risk management budget than many of their competitors.
That's a powerful differentiator in today's market. Let's delve into the specific dynamics of the insurance brokerage world itself. It's a really dynamic space right now, and the 2025 outlook seems to show several key growth drivers. One term that keeps coming up is the hard market. Can you just unpack what that means again and why it's such a significant driver for brokers like Marsh?
Sure. A hard market in insurance. Think of it as the insurance industry's version of a seller's market. Premiums are rising, often significantly, and insurers are becoming much more selective about who they cover and under what terms and conditions.
So tougher to get insurance and more expensive.
Exactly. This isn't just about insurers trying to make more profit, though. It's often a sign that insurers themselves have taken significant losses. Maybe due to a confluence of factors like escalating natural catastrophe claims from climate change, social inflation from larger legal judgments, or increased cyber losses. This makes them less willing or financially able to take on new risks without adequate pricing. This creates a high-stakes environment where clients desperately need Marsh's expertise and market clout to even secure the necessary coverage, let alone get good terms. It makes the broker's role incredibly valuable.
So the hard market actually increases demand for brokers.
It does, paradoxically. And beyond just pricing cycles, the fundamental driver is the increasing complexity of risk itself. We're talking about the proliferation of sophisticated cyber threats, the tangible financial and operational impacts of climate change becoming undeniable, heightened geopolitical instability, creating supply chain vulnerabilities, and political risk. All these factors significantly expand the universe of risks that organizations must manage and transfer, creating almost non-discretionary demand for expert advice and innovative risk transfer solutions.
So it's not just about rising prices, but a fundamentally more challenging risk landscape overall. What are some of the other dominant trends reshaping this insurance brokerage industry right now?
We're seeing two really dominant trends playing out. First, consolidation through mergers and acquisitions remains a defining characteristic. The global insurance brokerage landscape, particularly in the middle market segment, is still quite fragmented. Both large strategic players like MMC and Aon, and also aggressively capital-backed private equity firms, are actively acquiring smaller regional brokers.
Rolling them up.
Rolling them up. This M&A activity is driven by the desire to gain scale, add specialized capabilities like maybe niche cyber insurance expertise or industry-specific knowledge, and expand geographic footprint to better serve those multinational clients. Second, technology and digitalization are truly transforming every aspect of the value chain. The adoption of AI, machine learning, advanced data analytics. It's enabling far more sophisticated risk modeling, it's automating claims processes for greater efficiency, and it's delivering more personalized and efficient client service. Firms like Marsh that are investing heavily in these technologies are gaining a significant competitive edge. It allows them to offer superior insights and services and further entrench their position.
Makes sense. And what about the flip side? What challenges does the insurance brokerage industry face, even amidst these growth drivers?
Yeah, no industry is without its headwinds. The insurance brokerage industry, particularly in casualty lines like liability, faces a persistent challenge known as social inflation. This isn't traditional price inflation. It describes the rising costs of insurance claims due specifically to factors like increased litigation frequency, larger, more frequent nuclear jury awards, and sometimes broader definitions of corporate liability by courts.
So bigger lawsuits, bigger payouts.
Basically, yes. This puts significant upward pressure on premiums and can even impact the basic availability of coverage for certain high-risk industries. Additionally, the complex global regulatory environment is becoming even more intricate. New rules are constantly emerging around cybersecurity standards, data privacy, think GDPR in Europe or CCPA in California, and increasingly the ethical and fair use of AI in underwriting and claims processes. Navigating this labyrinth of regulations requires significant expertise and ongoing investment, presenting a constant challenge for all players in the market.
Now, let's pivot to the management consulting market. How does the 2025 outlook appear for this pillar of MMC's business, covering Oliver Wyman and parts of Mercer?
The management consulting market remains remarkably robust. It's constantly adapting to rapid change, which is, ironically, what drives the demand for consultants in the first place. We're seeing particularly strong demand in several key areas right now. Digital transformation remains a top priority for companies across pretty much all sectors. They are investing heavily in technology to optimize operations, enhance customer experience, build entirely new digital business models.
Still a huge area.
Huge. And closely related is the explosive growth in demand for AI strategy and implementation. Organizations are racing to harness the power of artificial intelligence while simultaneously needing expert guidance on managing its associated risks, everything from data privacy concerns to ethical implications and bias. Other significant growth areas include supply chain resilience, as companies continue to reevaluate and re-engineer their global networks after all the recent disruptions.
Yeah, that's not going away.
Not at all. And cost optimization. Businesses are always looking for efficiency, especially when facing ongoing economic uncertainties. These aren't fads. These are really fundamental long-term shifts in how businesses need to operate to stay competitive.
And what are the defining trends within this consulting landscape that firms like Oliver Wyman and Mercer are navigating?
There are two really dominant trends shaping the consulting industry itself. First, there's a pronounced shift towards specialization. The era of the generalist consultant seems to be waning. Clients are no longer just seeking broad strategic advice. They're increasingly demanding deep, domain-specific expertise to solve highly complex, often narrowly defined problems. This trend certainly benefits boutique firms that specialize in a particular niche, but it also benefits the specialized practices within larger multi-service firms like Oliver Wyman, who can leverage their specific industry and functional knowledge effectively.
So deep expertise is key.
Deep expertise is key. Second, and perhaps the most critical challenge for these firms, is the intense competition for talent. Consulting firms' primary asset is their human capital, right? Their intellectual property walks out the door every evening. The battle to attract, develop, and retain top-tier talent is fiercer than ever, especially for individuals with expertise in high-demand fields like AI, data science, advanced analytics. These people can command significant salary premiums. This talent war is a constant, ongoing challenge that requires continuous investment and focus.
So even with strong demand drivers, there are still significant hurdles. What are the main challenges facing the management consulting sector overall?
Indeed. Despite the robust demand, there are definitely challenges. Clients are becoming much more price sensitive and are increasingly demanding alternative fee arrangements. The traditional hourly billing model is being challenged more frequently by requests for things like outcome-based pricing, where consulting fees are tied directly to the achievement of specific measurable results.
Skin in the game, basically.
Exactly. It shifts some of the risk from the client to the consulting firm. There's also a growing trend of clients building sophisticated in-house strategy teams. Many large corporations are developing their own internal capabilities to handle ongoing, maybe less specialized strategic projects, which can reduce their reliance on external consultants for certain types of work. This means external firms really need to prove their value by focusing on those higher impact, more complex, or truly specialized engagements that the in-house teams maybe can't replicate.
That's a really comprehensive look at the industry dynamics for both insurance brokerage and consulting. So bringing it back to MMC specifically, what does this all mean for you, the learner, trying to understand where MMC fits in the broader competitive landscape? While many firms operate in different parts of this space, it's really important to see how MMC stacks up against its biggest rivals, its most direct competitors. We're talking about the other global giants like Aon, Willis Towers Watson, or WTW, and Arthur J. Gallagher & Co., AJG.
Right. And what's truly insightful here, I think, is that while these firms are often grouped together as peers, they each have pretty distinct strategic archetypes. MMC and Aon, for instance, are clearly the integrated global platforms, leveraging immense scale and broad service portfolios across risk and human capital. Arthur J. Gallagher, or AJG, has a highly successful, almost insatiable M&A roll-up strategy, especially focused on acquiring firms in the fragmented middle market for insurance brokerage. They're masters at acquisition integration.
Yeah, they buy a lot of companies.
They do. And Willis Towers Watson, WTW, especially post-restructuring after its terminated merger attempt with Aon a few years back, is perhaps more of a focused margin improvement and turnaround story right now, streamlining its operations and focusing on core strengths. Now, when we look at MMC in comparison, its strategy appears arguably the most balanced. It consistently combines strong organic growth, meaning growth from its existing businesses, not just acquisitions, with a proven ability to expand operating margins and a highly disciplined capital allocation program. That includes strategic M&A, but also consistent dividend growth and programmatic share repurchases.
So growth from within and smart deals.
Exactly. This balanced approach tends to generate a superior, perhaps more predictable financial profile over the long term. For a risk-averse, long-term investor, this might position MMC as a potential core holding in a diversified portfolio. It arguably offers more stability compared to, say, AJG's M&A-dependent model, which inherently carries integration risk with every deal, or maybe WTW's turnaround narrative, which might have less long-term visibility at this stage.
That distinction in strategy is really key. Let's look at some numbers to really illustrate this. We have a comparison table here pitting MMC against these peers across several key metrics. Let's pull out some of the most telling figures for you. Starting with market capitalization, MMC stands at approximately $103.5 billion. This makes it significantly larger than Aon at around $80.7 billion, WTW at about $31.7 billion, and AGG at roughly $77.7 billion. This market cap signifies not just its immense scale, but its broad market presence and clearly significant investor confidence.
It's the biggest by a decent margin.
Right. Then when we look at total revenue for the trailing 12 months TTM, MMC again leads the pack with $25.8 billion. That dwarfs Aon's $16.8 billion, WTW's $9.9 billion, and AGG's $11.4 billion. This sheer scale, as we've discussed, is absolutely crucial for serving those large multinational clients and for investing in the leading-edge capabilities we've been talking about, like advanced analytics and AI.
And drilling down a bit further, when we look at organic revenue growth for fiscal year 2024, which is, as you said, a key indicator of the underlying health and vitality of a business without the artificial boost of acquisitions, MMC achieved a strong 7%. This matched AJG's 7% and notably outperformed Aon at 6% and WTW at 5%. That demonstrates MMC's strong ability to grow its core businesses organically, which many analysts consider higher quality growth.
Okay, strong organic growth. But what about profitability? How do the margins compare?
Right, that's the other side of the coin. On adjusted operating or EBITDAC margin for FY 2024, EBITDAC being earnings before interest, taxes, depreciation, amortization, and change in contingent consideration, a common profitability metric in this industry. Aon and AJG actually show higher margins, both around 31.4% or 31.5%. That compares to MMC's 25.4% and WTW's 23.9%.
Interesting. So Aon and AJG are more profitable on that basis? Why might that be?
Well, there could be several reasons. It might be due to a different business mix. Perhaps Aon and AJG have a slightly more concentrated, potentially higher margin brokerage focus compared to MMC's broader portfolio, including consulting. Or it could reflect different operational structures, maybe different stages and M&A integration cycles for AJG. It's definitely a point worth noting as we evaluate the overall value proposition. MMC has room to potentially improve margins further, though its track record there is already strong.
Okay. Now, moving to valuation multiples, which help us understand how the market is pricing these companies relative to their earnings or cash flow. The forward price-to-earnings PE ratio for MMC is around 22.0 times estimated future earnings. This is actually slightly lower than Aon's 22.2x and significantly lower than AGG's 27.4x, though it is higher than WTW's 19.8x. This ratio helps us gauge how much investors are willing to pay for each dollar of anticipated future earnings.
Right. And then looking at the enterprise value to EBITDA ratio for the trailing 12 months, which is that capital structure neutral metric giving a clearer picture of valuation independent of debt levels. MMC stands at 15.9x. This actually appears more attractive or cheaper than Aon's 18.1x and AGG's 22.0x, although it's higher than WTW's 13.9x. So on this measure, MMC looks relatively well valued compared to key peers.
And here's where MMC truly distinguishes itself, particularly for investors seeking both growth and income, right? The dividend picture.
Absolutely. Its forward dividend yield is 1.70%. Now, while that's not the highest absolute yield you'll find in the market, it's notably better than Aon's 0.80%, WTW's 1.10%, and AJG's 0.86%. But even more impressively, MMC's 5-year dividend growth rate, the compound annual growth rate, CAGR, is a really robust 12.82%.
Wow, it's strong growth.
It significantly outperforms all its peers. Aon is at 10.04%, WTW at 6.48%, and AJG at 7.27%. That consistent, strong, and clearly superior dividend growth isn't just a number on a page. It's a powerful signal. It signals management's confidence in future cash flows, their commitment to returning capital to shareholders, and the underlying financial strength and predictability of the business. For an income-focused investor, or even a total return investor, this makes MMC a particularly compelling choice within the peer group.
That's a striking difference in dividend growth, yeah. So with some metrics like operating margin appearing maybe a bit lower than a peer like AGG, why might MMC's current valuation, which is often considered a premium to the broader market, still be justified? What's the hidden value, or the reason the market consistently gives it such a strong rating?
That's the key question, isn't it? Given MMC's clearly superior dividend growth track record, its remarkable consistency and high quality of operational performance over many years, and its truly balanced approach combining robust organic growth, that impressive history of margin improvement, and disciplined strategic M&A, The case for its premium valuation becomes quite clear, I think.
It's the whole package.
It's the whole package and the predictability of that package. MMC offers a more de-risked growth profile and arguably a more resilient financial trajectory through cycles than many of its peers. The market seems willing to pay a premium for that reliability, for that proven track record of compounding value year after year, and for the confidence that comes with its market leadership and that powerful integrated model. In essence, you're paying for enduring quality and consistency, which, frankly, in a volatile world, seems increasingly valuable to investors.
Enduring quality and consistency, that certainly resonates. Okay, let's delve even deeper into the numbers themselves. A truly great company often has a financial history that tells a compelling story on its own, and MMC certainly seems to fit that bill. We're talking about a durable, high-quality earnings stream, a robust balance sheet, and a really smart, disciplined approach to how they use their capital. It also benefits immensely from what's often called a capital-light business model and a high conversion of earnings into free cash flow. Can you just quickly unpack what capital-light means and why it's such an advantage in this industry?
Sure. Capital light in this context basically means that MMC's core businesses, which are primarily professional services and advisory, don't require massive ongoing investments in physical assets like factories, heavy machinery, or extensive inventory to generate revenue and grow. Their primary assets are intangible: intellectual capital, data, brand reputation, and crucially, their people.
Right, brain power, not buildings.
Exactly. This is a huge advantage because it means a significant percentage of their net income can be converted directly into free cash flow. Free cash flow is essentially the cash a company has left over after paying for its operating expenses and its capital expenditures, which are low in a capital-light model. And that free cash flow is the lifeblood for everything else: paying dividends, buying back shares, funding M&A activity, and reducing debt if needed. It gives them tremendous financial flexibility.
That makes perfect sense. Less capital tied up in physical assets means more financial flexibility to reward shareholders or invest strategically. So what does MMC's historical financial performance tell us, specifically regarding its growth and profitability trends over time?
What's truly remarkable here is the sheer consistency. MMC has achieved, according to the sources, 13 consecutive years of underlying revenue growth. That's not just a good run, that's a powerful testament to the enduring demand for its services and the effectiveness of its integrated model through various economic backdrops over more than a decade. For 2024, they continued this impressive streak, reporting 8% total revenue growth with 7% on an underlying basis, essentially extending what they called their strongest growth stretch in over 2 decades.
That's impressive. Top-line consistency. What about the bottom line?
Even more impressive, perhaps, and certainly a rare feat, is their reported record of 17 consecutive years of adjusted operating margin expansion. 17 years. This isn't just about cutting costs for a quarter or two. This demonstrates a deeply ingrained culture of operational excellence, proving they can consistently grow revenue faster than expenses over a very long period. This relentless financial discipline, combined with their capital-light business model, has translated into double-digit adjusted EPS growth for 4 consecutive years now, including 10% growth reported for 2024 and consistent adjusted EPS growth over the past 15 years. This isn't just luck, it's clear strategic execution paying off year after year.
That is an incredible track record of both top-line growth and bottom-line efficiency improvement. Okay, let's get into the nitty-gritty of how each pillar is performing financially, giving you, the listener, a detailed view of their drivers from 2020 through 2024 based on the data provided. For the Risk and Insurance Services RIS segment, the bigger one with Marsh & Guy Carpenter, what did the numbers reveal over that period?
Yeah, for RIS, the numbers are truly compelling. We've seen incredibly steady revenue growth, escalating from $10.3 billion back in 2020 to $15.4 billion in 2024. That represents a robust 5-year compound annual growth rate, or KGR, of 10.6%. Even more striking is the surge in operating income within RIS. That grew from $2.3 billion in 2020 to $4.4 billion in 2024. That's a phenomenal 5-year KGR of 17.4%.
Wow, income growing much faster than revenue.
Exactly. This impressive growth in operating income drove a significant operating margin expansion within the RIS segment, moving from 22.3% back in 2020 up to 28.4% in 2024. That consistent, almost relentless margin expansion in their largest and most resilient segment is incredibly powerful. It speaks volumes about their operational efficiency, their pricing power, especially benefiting from the hard market conditions, and their ability to leverage their scale effectively, consistently growing profits much faster than revenue.
And how did the consulting segment, the other pillar encompassing Mercer and Oliver Wyman, perform during that same 2020-2024 period?
The consulting segment also demonstrated consistent and strong performance. albeit with slightly different dynamics. Revenue climbed steadily from $7.0 billion in 2020 to $9.1 billion in 2024, achieving a very respectable 5-year CAGR of 6.9%. Their operating income showed equally strong growth, increasing from $1.0 billion in 2020 to $1.8 billion in 2024, which represents a strong 5-year CAGR of 15.3%.
Still very strong income growth there.
Very strong. Now, their operating margin in consulting remained relatively stable and healthy, hovering around 19% to 19.4% in the years after 2020. While not showing the same dramatic expansion as RIS, it still reflects the inherently high-margin nature of specialized consulting work. It proves that even in a segment that can sometimes be more cyclical, Mercer and Oliver Wyman are delivering consistent, high-quality profitability year after year.
And pulling all that together, what do the consolidated totals for MMC tell us about the overall financial trajectory of the entire company during this period?
Looking at the consolidated totals, the picture is clearly one of robust, well-managed growth across the board. Total revenue for MMC grew impressively from $17.2 billion back in 2020 to $24.5 billion in 2024, resulting in a solid 9.1% CAGR over those 5 years. Total operating income saw an even more impressive jump, moving from $3.1 billion to $5.8 billion over the same period. That's a striking 17.0% CAGR for consolidated operating income. These aggregate numbers unequivocally underscore the overall health, the strong growth trajectory, and the exceptional operational leverage of the entire company, driven by powerful performance in both its dominant RIS segment and its high-value consulting segment.
So if we connect this back to the bigger picture, MMC's capital light model means it generates a high percentage of net income into free cash flow, which is that crucial lifeblood for growth and shareholder returns. We know their balance sheet is strong, providing financial flexibility. But how does this translate into actual returns on capital for shareholders? Are they using that capital effectively?
Yes, this is where their financial discipline really shines, and you see the effectiveness. The capital light model, as we said, directly fuels a very high conversion rate of net income into free cash flow. This robust cash generation is what allows MMC to both consistently invest in growth opportunities and consistently reward shareholders through dividends and buybacks. Their balance sheet is exceptionally strong, characterized by prudent debt management and ample liquidity, providing significant financial flexibility to pursue strategic initiatives like M&A without undue strain. Furthermore, their high returns on capital are a key indicator of management's effectiveness and the inherent profitability of the business model. For example, their return on equity, or ROE, was reported at an excellent 30.4% in 2024.
That's very high.
It's very high. It demonstrates the high profitability generated for shareholders relative to their equity investment in the company. Similarly, its return on invested capital, or ROIC, was reported at 11.6% in 2024. ROIC measures how well a company is generating cash flow from all the capital it has invested in its business, both debt and equity. An 11.6% ROIC, especially for a mature, large-cap firm like MMC, indicates exceptionally efficient and profitable use of capital across the entire enterprise. These are really strong figures.
Those are indeed excellent figures, indicating very strong management and efficient use of capital. So what does this all mean for how they actually manage their money day to day? MMCs seem to have a clear, balanced strategy for deploying all that capital they generate, always focused on creating long-term shareholder value. The report mentioned they expect to deploy approximately $4.2 billion in 2024 alone across these priorities. Let's break down each component, starting with dividends. How central is that to their strategy?
Dividends are clearly a cornerstone of MMC's shareholder return strategy, and they boast a truly impressive track record here. As we noted, the company has increased its dividend for 15 consecutive years. That's not just a casual payout, it's a powerful signal. It signals consistent confidence from management in future cash flows, a deep commitment to returning capital directly to shareholders, and it serves as a testament to the durability and predictability of their earnings stream. For long-term investors, a steadily growing dividend from a high-quality company like MMC can be a significant component of total investment returns over time. It's a hallmark of a mature, stable compounder.
Makes sense. Beyond dividends, they also actively engage in share repurchases. What's the strategy behind buying back their own stock, and how does that benefit shareholders?
Right. MMC utilizes a programmatic share repurchase plan, which typically serves a dual purpose. Firstly, it's designed to offset the dilution that naturally occurs from equity-based compensation programs for employees, ensuring that the total number of shares outstanding doesn't creep up simply due to employee stock grants. Secondly, and often more strategically, they use buybacks opportunistically to reduce their overall share count, particularly when management believes the stock might be undervalued relative to its intrinsic worth. In 2022, for instance, the company executed a significant $1.9 billion in share repurchases, which was noted as the largest annual amount in its history up to that point. This demonstrates active and flexible management of its capital structure, aiming to enhance earnings per share by reducing the number of shares and overall shareholder value over time.
Okay, so offsetting dilution and boosting EPS. And finally, a significant component of their growth strategy seems to be mergers and acquisitions, M&A. MNC has a reputation as a disciplined acquirer, but 2024 really stood out as a record year for acquisitions, didn't it?
Yeah.
Can you tell us more about their M&A approach, particularly with that massive $7.75 billion deal we keep hearing about?
Yes, M&A is indeed a key component of MMC's growth and overall strategy. They use it strategically to add talent, enhance specific capabilities like in digital or cyber, and increase scale in attractive markets or segments. They've built a strong reputation over many years as a highly disciplined acquirer, meaning they tend to be selective and focus on targets that provide clear strategic fits and are expected to be financially accretive, meaning boosting earnings per share. The 2024 period, however, marks the largest year for acquisitions in the company's entire history. This was undeniably highlighted by that monumental $7.75 billion acquisition of McGriff Insurance Services from Truist Financial.
That was a huge deal.
Huge. This wasn't just a small tuck-in acquisition. This was a truly transformative strategic move. McGriff significantly expanded MMC's presence and capabilities in the U.S. middle-market insurance brokerage space, bringing a substantial client base and specialized expertise that complements Marsh's existing offerings in that important segment. It demonstrates that while MMC is generally disciplined, they are also willing and able to make large, bold, strategic moves when the right opportunity arises to significantly bolster their competitive position, expand into attractive growth segments, and enhance their overall long-term value proposition. It's about being opportunistic and highly strategic.
That's a truly detailed look at their financial engine and how they deploy capital so effectively. But here's where it gets really interesting, I think. Behind all these impressive numbers, behind every strategic decision, behind the integrated model, are people. Strong corporate governance and experienced leadership are absolutely critical for long-term success, ensuring alignment between management, the board, and ultimately the shareholders. So what does MMC's leadership structure actually look like? Who's running the show?
Yeah, the depth of experience within MMC's leadership team is genuinely impressive and undoubtedly a significant factor in their consistent success over the years. The company is currently led by President and Chief Executive Officer John Q. Doyle. He's a highly regarded executive with over 35 years of experience in the insurance and risk management industry. Crucially, before becoming CEO of the entire company, he previously led Marsh, which is their largest and arguably most complex operating segment.
So he knows the core business inside out.
Inside out. This provides really strong, stable leadership at the very top, deeply familiar with the core operations and the market dynamics. The executive committee further reinforces the stability and expertise. It includes long-tenured, experienced leaders for each of the four main businesses. Martin South currently leads Marsh, Dean Klazura heads Guy Carpenter, Pat Tollinson is at Mercer, and Nick Studer runs Oliver Wyman. This ensures operational continuity and deep functional and industry expertise at the highest level of each distinct organization, fostering a culture of specialized leadership that understands the specific nuances of their respective markets.
That continuity and deep industry experience sound like a huge advantage. This raises an important question about oversight, though. How is the board of directors structured? Does it provide truly independent guidance and ensure robust corporate governance practices are followed?
MMC's board appears to be structured for exceptionally strong independent oversight, which is widely considered a best practice in modern corporate governance. As of their 2025 annual meeting materials, a remarkable 91% of the board's 11 directors are classified as independent. Furthermore, the critical roles of CEO and chairman of the board are separate. John Doyle is CEO, while H. Edward Hanway serves as the independent chair.
That separation is important, right?
Very important. It promotes a healthy balance of power between management and the board, helps prevent potential conflicts of interest, and ensures that the board can effectively challenge and advise management from an independent perspective. The board also demonstrates a clear commitment to diversity, with 36% of its members being women as of that report, bringing a wider range of perspectives and experiences to strategic discussions. Its 6 standing committees covering areas like audit, compensation, directors and governance, finance, business responsibility, and the executive committee are composed entirely of independent directors, with the only standard exceptions being the CEO's membership on the finance and executive committees. This structure ensures that critical functions like financial reporting oversight, executive compensation setting, and strategic direction are managed with the utmost impartiality and rigor.
That level of independent oversight is certainly reassuring for shareholders. So, what does this all mean for how the leaders themselves are incentivized? How does MMC's executive compensation program work to align executive interests directly with the goal of creating long-term shareholder value? Does it actually work?
Yes. MMC's executive compensation program seems meticulously designed to do just that, tie pay directly to performance and long-term value creation. A very high percentage of their target total direct compensation is variable, meaning it's at risk and dependent on achieving specific goals. For instance, the report stated that approximately 93% of the CEO's target pay is variable, and it averages around 83% for the other named executive officers.
So, mostly performance-based, not guaranteed salary.
Exactly. This high leverage means that a significant portion of their potential earnings is directly dependent on achieving key financial and strategic objectives set by the board. What's particularly well aligned with shareholder interests, I think, is the structure of their long-term incentive, or LTI awards. These awards are strategically granted as 50% performance stock units, or PSUs, and 50% traditional stock options.
Okay, what are PSUs tied to?
The vesting of those PSUs, meaning when the executives actually receive the shares, is tied to 2 rigorous metrics measured over a challenging 3-year performance period. The first is annualized adjusted EPS growth, which focuses squarely on fundamental earnings power generation. The second is the company's total shareholder return, or TSR, measured relative to the performance of the S&P 500 index.
So, growth and beating the market?
Precisely. This dual focus directly rewards management for both delivering strong underlying earnings growth and for generating superior stock performance compared to the broader market. The program's effectiveness seems clearly evidenced by the fact that the maximum 200% payout was achieved for the 2022-2024 PSU cycle. This was driven by both strong adjusted EPS growth during that period and top quartile relative TSR performance. So it's not just theoretical, it's a demonstrable result tied to actual company performance.
And do shareholders seem happy with this approach?
Apparently so. Shareholder support for this compensation framework appears strong, evidenced by a 93% approval vote on the company's advisory, say, on pay proposal at the 2024 annual meeting. Plus, they maintain robust stock ownership guidelines, requiring the CEO, for example, to hold MMC stock valued at 6 times his base salary, which further solidifies the alignment of their personal financial interests with long-term shareholder success.
That's a comprehensive approach to governance and compensation, clearly designed to keep executives focused on long-term value creation. Okay, let's pivot now and unpack one of the most important questions for any potential investor. Is Marsh McLennan currently a good value? We've talked extensively about its quality, its consistent growth, its strong leadership, but now we need to see if the current market price truly reflects all that. It's often said that MMC trades at a premium, but the analysis suggests this premium might actually be well justified.
Right, it's crucial to put MMC's valuation into some historical context first. What's truly insightful here is looking at MMC's historical valuation multiples over time. Over the past 10 years, its average price-to-earnings, or PE, ratio was about 25.8 times earnings. The current trailing 12-month TTM PE, as of the report, was roughly 25.1 times. That's pretty much right in line with its own long-term historical average. It suggests that at present, it's not trading at an excessively expensive level compared to its own past performance track record.
So not cheap, but not way out of line with its history.
Exactly. Similarly, looking at the 5-year average enterprise value to EBITDA, or EV/EBITDA, that was around 16.9 times. The current TTM EV/EBITDA of 15.9 times is actually slightly below that recent average. This also indicates a very reasonable valuation on these key historical measures, suggesting the market isn't wildly overpaying for its current earnings or operational cash flow relative to its own established norms. For a company of this demonstrated quality and consistent growth, trading in line with or even slightly below its historical averages is often seen as a favorable sign by investors.
Okay, so on a historical basis relative to itself, it looks reasonable. Now let's bring back our peer group Aon, WTW, and AJG to see how MMC's current valuation stacks up against its direct competitors. This is crucial for understanding its relative attractiveness in the market today. How do the current and average PE ratios compare across the group?
Sure. Looking at the current PE, TTM, MMC is at that 25.1x. Compare that to Aon, which was higher at 31.3x, and AJG significantly higher at 44.9x. Willis Towers Watson's TTM PE was extremely high, over 250x, but that was distorted by a reported net loss in 2024, making its forward PE estimate of around 19.8x a more meaningful comparison point for WTW. Now, when we consider the 5-year average PE for these firms, MMC is at 26.8x compared to Aon at 31.8x, WTW at 24.8x, and AJG way up at 39.3x on average.
So MMC's PE is generally lower than Aon and AJG, both currently and historically.
Generally, yes. These numbers highlight that while MMC clearly commands a premium valuation relative to the broader market index, it often trades at a lower PE multiple than some of its direct, often faster growing, partly through M&A peers like Aon and particularly AJG, which frequently carry higher valuation multiples due to their specific growth profiles or perhaps different margin structures.
Okay. What about the EV/EBITDA comparison, which, as you explained earlier, gives us that capital structure neutral view, looking at the whole enterprise value relative to operating cash flow?
Right. For current EV/EBITDA, TTM, MMC is at 15.9x. As we saw, this is actually more attractive, meaning lower than Aon at 18.1x and AGG way up at 22.0. It is higher than WTW, which was at 13.9x. Looking at the 5-year average EV/EBITDA, MMC's average is 16.9x. That compares favorably to Aon's estimated average around 22.3x and AGG's average of 20.8x. WTW's average was lower at 14.2x. So these metrics suggest that on an enterprise value basis, considering both debt and equity, MMC is trading at a more compelling multiple than some of its high-flying competitors like Aon and AJG, indicating that its substantial operational cash flow is perhaps being valued quite efficiently by the market relative to those peers.
Okay, so when we put all these valuation numbers and comparisons together, historical, peer-based, PE, EV/EBITDA, what's the overall conclusion from this valuation analysis? Does MMC's current valuation seem fair, maybe overvalued given the premium, or perhaps even reasonably valued or undervalued given its undeniable quality?
Well, if we connect all this back to the bigger picture, MMC trades broadly in line with, or even slightly below, its own historical valuation averages, which for a company of this caliber and consistency is generally a positive sign. Compared to its closest peers, its valuation seems quite reasonable, and on some important metrics like EBITDA, it actually looks relatively attractive compared to Aon and AJG. While AJG, for instance, consistently commands a higher PE ratio, often justified in the market by its aggressive and successful M&A-fueled growth strategy, MMC's EBITDA multiple offers a compelling counterargument from a cash flow perspective.
So why does it still command that premium relative to the broader market? What justifies paying up for MMC?
I think this raises the important question. Why might it consistently command that premium relative to the S&P 500 or other industries? The answer likely lies in everything we've discussed. MMC's superior track record of consistent organic revenue growth, that truly remarkable 17 consecutive years of operating margin expansion, its excellent and predictable shareholder returns, particularly its best-in-class dividend growth within the peer group, its market leadership, and the resilience of its integrated business model. All these factors combined suggest that a valuation in line with its history and at a premium to some peers or the broader market isn't just acceptable, it's arguably well justified. It's fundamentally a reflection of its proven quality, its predictability, and its long-term earnings power attributes that investors are clearly willing to pay a premium for, especially in uncertain economic times. It's seen as an investment in a durable, compounding enterprise.
Durable compounding enterprise. That's a really strong summation of the investment profile. Okay, so after covering the business, the industry, the financials, the leadership, and the valuation, what does this all mean for you, the listener, trying to make an informed decision or simply understand the core investment case? We've gathered a wealth of information, and now it's really time to distill it all down into a clear investment thesis, looking at both the opportunities, the bull case, and the potential pitfalls, the bear case, along with a final comprehensive risk assessment.
Exactly, and what's truly fascinating here, I think, is how the comprehensive analysis we've walked through culminates in a really compelling bull case for Marsh McLennan. It seems to rest on 5 exceptionally strong pillars. First, there's that durable market leadership. MMC isn't just a participant in its markets, it's the #1 or #2 global leader in each of its 4 core businesses. This unparalleled scale confers massive negotiating leverage, especially with insurance carriers, provides access to proprietary data and analytics like GAP that others can't match, and establishes a powerful global brand that attracts both top-tier talent and the largest, most complex global clients. This creates an incredibly wide and deep competitive moat that is extremely difficult for any rival to replicate or overcome.
That market leadership certainly creates a formidable foundation for long-term success. Hard to argue with that.
Very hard. Second, we have that resilient capital-light business model. As we discussed, a significant portion of its revenue, particularly within the large RIS segment, is highly recurring and largely non-discretionary for its clients. And because its core business is intellectual capital, not physical assets, it doesn't require massive ongoing capital expenditures to maintain and grow operations. This leads to prodigious and predictable free cash flow generation year after year. This financial flexibility and inherent resilience are absolutely key to sustaining shareholder value creation through various economic cycles.
Right, the cash machine aspect.
The cash machine aspect, exactly. Third, MMC benefits immensely from a powerful alignment with secular growth tailwinds. It is perfectly positioned right at the nexus of increasing global risk complexity. Think about the escalating impacts of climate change, the relentless sophistication of cyber threats, the fluidity of geopolitical instability, and the critical strategic importance of human capital managing soaring healthcare costs, designing robust retirement solutions for aging populations, winning that intense global war for talent. These are huge, long-term, non-negotiable trends that provide an incredibly long runway for sustained organic growth for years, probably decades to come.
Those are undeniably powerful macro drivers, suggesting strong future demand almost baked in.
Almost baked in, yeah. Fourth, the company has that incredible track record of proven operational excellence. That impressive record we keep coming back to, 17 consecutive years of adjusted operating margin expansion, is almost unheard of for a company of this size, maturity, and complexity. It is a powerful testament to a deeply ingrained culture of efficiency, strategic cost management, disciplined execution across all its businesses, allowing them to structurally grow earnings faster than revenue over the very long term. That operational leverage is a powerful engine for compounding shareholder value. And finally, pillar number 5, there's MMC's disciplined and shareholder-friendly capital allocation. They have that consistent history of dividend increases, 15 consecutive years, now demonstrating a strong commitment to income investors. They employ programmatic share repurchases to offset dilution and opportunistically boost EPS. And they have a proven long-term track record of successful, generally value-accretive mergers and acquisitions, including strategic big moves like the recent transformative McGriff acquisition. This disciplined, balanced approach consistently maximizes long-term total returns for shareholders.
Okay, that is a very compelling and well-supported case for the bull argument. 5 strong pillars. But as with any potential investment, a balanced view is absolutely crucial. It's important we look at the other side of the coin, what could potentially go wrong. The bear case highlights some key concerns that investors should definitely be aware of.
Absolutely. No investment is without risk, and the bear case for MMC, based on the analysis, seems to outline 4 primary concerns that warrant attention. First, there's macroeconomic sensitivity. While MMC's integrated model clearly provides significant resilience compared to many other industries, its businesses are not entirely immune to a severe, prolonged global recession. Such a downturn could negatively impact the more discretionary revenue streams, particularly in Oliver Wyman's project-based strategy consulting work, which clients might choose to defer or cut back on in really tough economic times. A deep recession could also significantly slow down global M&A activity, which is a key growth driver not just for MMC's advisory businesses, but for the broader professional services industry.
Right. So while generally stable and resilient, they still have some exposure to major economic shocks, particularly on the consulting side of the house.
Precisely. Second, there's the ongoing reality of competitive intensity. The global professional services landscape is fiercely competitive, and it's not getting any easier. MMC faces formidable global competition from large integrated peers like Aon, but also from a growing host of highly specialized boutique firms and potentially new technology-driven entrants who are leveraging AI and advanced data analytics to try and disrupt traditional consulting and brokerage models. This competition exists not only for client relationships and winning mandates, but also, crucially, for attracting and retaining that top-tier talent, which, as we've said, is the firm's most critical asset. The battle for the brightest minds is constant and expensive.
Yeah, talent really is the core asset for these types of firms, and a significant loss of key people there could genuinely impact the business.
It absolutely could. Third, There's always M&A integration risk. While M&A is a core and generally successful component of MNC's growth strategy, and 2024 was indeed a record year for acquisition spending, highlighted by McGriff. Large-scale acquisitions always carry inherent risks. These include the potential for culture clashes between the integrating organizations, the risk of failing to achieve the projected synergies, meaning the expected cost savings or revenue boosts don't fully materialize as planned, and the ever-present risk of simply overpaying for assets in a competitive deal environment, which could dilute shareholder value. Even with MNC's strong track record in M&A, the sheer scale of the McGriff acquisition means successful integration is a key factor for investors to monitor closely over the next couple of years.
Makes sense. And finally, a big one for any high-quality, consistently performing company that tends to trade well.
Fourth, and importantly, valuation risk. Because MMC is recognized as a high-quality, market-leading industry player, its stock typically trades at a premium valuation relative to the broader market and often to some of its peers. This implies that high expectations for future growth, profitability, and continued flawless execution are already largely reflected or priced in to the current stock price. This leaves less room for error, frankly. Any significant operational misstep, an unexpected prolonged slowdown in growth, or an unforeseen negative change in market dynamics could potentially lead to a contraction in its valuation multiple, resulting in stock underperformance even if the underlying business remains fundamentally sound. Investors need to be aware that the premium price means there's arguably less margin for safety if things don't go perfectly according to plan.
Okay, those are the four main bear points. Beyond those major themes, the company itself, in its filings, outlines other specific risks that we should probably be aware of too, right?
Yes, absolutely. Beyond those major strategic themes, there are other specific risks the company itself flags that are important context. These include the ongoing impact of geopolitical and macroeconomic conditions, things like wars and global conflicts, the imposition of tariffs or significant changes in trade policy, slower GDP growth or outright recessions in key operating markets, and volatility in interest rates and foreign exchange rates, all of which can impact client demand or operational costs unexpectedly. Then there are significant legal and regulatory risks. Given the nature of its advisory work, the company is constantly exposed to potential lawsuits arising from alleged errors and omissions or breaches of fiduciary duty. It must also comply with a complex and ever-evolving web of global regulations, including stringent anti-corruption laws like the U.S. Foreign Corrupt Practices Act, FCPA, comprehensive data privacy laws such as GDPR in Europe, evolving cybersecurity regulations, and increasingly new rules and ethical considerations around the use of artificial intelligence in its services and client recommendations.
And cybersecurity is a big one on its own too.
Huge. Cybersecurity threats are an increasing and pervasive concern for all large organizations, and MMC is no exception. The growing prevalence and sophistication of ransomware attacks, data breaches, and other forms of cyber attacks pose a significant potential threat not only to the company's own internal operations and valuable intellectual property, but also, critically, to the security and confidentiality of its vast amounts of sensitive client data. A major breach could lead to severe reputational damage, significant financial penalties, and loss of client trust. Beyond that, talent management remains absolutely critical. The company's long-term success is fundamentally dependent on its ability to consistently attract, retain, and develop industry-leading talent in a highly competitive global market, especially in specialized high-demand areas like data science, cyber risk, and sustainable finance. If they fail to win the talent war, their competitive edge could genuinely erode over time. And finally, as a large, multi-service firm, MMC must constantly and carefully manage potential conflicts of interest that may arise when its services provided to one client could potentially be perceived to conflict with the interests of another client, or perhaps even with the firm's own interest, for example, in investment consulting. Maintaining strict ethical boundaries and transparent disclosure processes is absolutely paramount to preserving client trust and regulatory compliance.
Okay, that's a very comprehensive and balanced perspective, covering both the significant upside potential and the key risks and challenges. So wrapping this all up, what does this mean for you, the listener, trying to synthesize everything we've discussed in this deep dive into Marsh McLennan? The report we analyzed concludes that MMC enters 2025 with significant positive momentum. Management projects continued mid-single-digit or potentially better underlying revenue growth, further gradual expansion of its adjusted operating margin, and solid ongoing growth in adjusted earnings per share. This positive outlook seems built on their strong market leadership positions, those consistent investments in talent and technology we highlighted, and ongoing benefits derived from their powerful integrated business model. Strategic priorities moving forward include enhancing data and analytics capabilities across all businesses, capturing more cross-business synergy opportunities, and maintaining that disciplined M&A approach, including, importantly, successfully integrating and leveraging the significant McGriff acquisition to strengthen its U.S. middle market platform. Those are the key focus areas.
And based on that analysis, the report concludes with a formal, generally favorable investment recommendation classifying MMC as accumulate. Essentially, they see it as a high-quality blue-chip compounder, suitable as a core long-term position within a diversified equity portfolio. It seems particularly appropriate for investors seeking consistent growth, reliable and rising dividend income, and perhaps a lower-than-market overall risk profile due to its resilience and diversification.
Okay, an accumulate rating. That's the final verdict from the source material.
Right. But maybe stepping back from the specific recommendation, this raises a final, perhaps more provocative question for you, the learner, to think about. Beyond just the numbers and the impressive track record of MMC itself, consider how their success in seamlessly integrating these seemingly disparate services, risk management, strategic consulting, and human capital solutions, provides a really fascinating blueprint for how businesses might navigate the future of complex global operations. What other industries, perhaps even well outside of traditional professional services, might benefit from adopting such a deeply integrated, multidisciplinary approach to solving their biggest problems? And how might that kind of shift ultimately reshape their competitive landscapes moving forward?
That's a great question. Where else could this master conductor model work?
Exactly. Think about it. In a world that often seems to be driving towards ever-increasing specialization and creating information silos, perhaps the most powerful, enduring competitive advantage in the future will actually lie in mastering the art of synthesis, in connecting the dots that others miss, and in being able to offer that truly holistic perspective to solve the most complex challenges. Maybe integration is the new specialization.
That's a lot to chew on. And it really does highlight the power of understanding how these global giants operate, not just as collections of individual businesses, but as truly integrated ecosystems. Thank you so much for joining us on this deep dive into Marsh McLennan. We sincerely hope this has given you a valuable shortcut to being truly well-informed about this influential company, and maybe, just maybe, spark some new ideas for your own understanding of the business world and that powerful art of synthesis.